Hey everyone, it's Scott Curry here with your daily property update coming to you from Hollywood, Los Angeles. Let's get into it because right now we are seeing record after record after record being broken in the property market. Now, the monthly data has just dropped. Now, over the last 3 months, we have seen continued house price growth. In fact, we are seeing record house price growth. And I have been warning about this now for the last 12 to 18 months that we would see the last and final boom of the 2020s, taking us from 2025 to 2030. We're gonna see record price growth. And here it is, guys, happening right before us. Prices are continuing to rise. Buyers are flooding into the market. The market is getting crazier and crazier. Is the story any different this month? Breaking news, absolutely no, not even close. Now here's the twist, guys, and this is the part nobody's ready for. The environment has actually turned against rising property prices. I'm not kidding. In the last 30 days, we've seen a wave of new developments that, on paper, should have slammed the brakes on the market. In fact, some of this stuff is so serious, it should be forcing banks to rethink their 2026 forecast. Let me show you what I mean. Firstly, APRA has come out swinging against investors. They've been talking about cracking down on risky loans. In addition to that, the RBA is basically warning Aussies, don't expect any more help in terms of rate cuts. Also, most of the big banks have quietly pulled future rate cuts off the table. Inflation has actually jumped again, which opens the door to a possible rate hike next year. Now, if you put all of that together, you would think, okay, surely this time the property market has to finally slow down, and yet property prices are still going higher. So now the real question is this: will this momentum continue into 2026? How much property price growth is left in the market? Or has the market just quietly flipped overnight? In this video, I'm going to break down where prices are rising the fastest, where the slowdown is actually happening. I'm going to cover the 2 new segments Cotality says the market has split into, and also why this will force buyers to rethink their strategy in 2026. And finally, the most important question: will property prices now finally slow down in 2026? Let's get into it. So first up, the latest Cotality and PropTrack data is out. And once again, the headline reads, home values up another 1% nationally this month. This is the 3rd month in a row of national house price growth. This is the 10th month of growth this year. This is not a blip. This is not a post-rate cut bounce. This is a full-scale acceleration of house prices. And here is the real story the headlines actually won't tell you. The Aussie housing market has officially split into 2 segments, not by city, but by behavior. Not big versus small, not east versus west, not units versus houses. These are 2 price segments. Segment A, markets where people can still physically afford to buy, so demand in these areas is explosive. And segment B, markets where people have hit the borrowing wall. So in these areas, growth has slowed, not because demand died, but because wallets have actually dried up. This split explains everything that's happening. Let's break them down. First of all, segment A, where the market is still booming. In fact, it is accelerating. If you want to see where the market is generally on fire, look here. Perth, the runaway leader, up around 2.4% this month alone. Listings are still down over 40%. Homes are selling in days, not weeks or months. This is a true supply choke. Brisbane is still accelerating, up around 1.7% to 2% this month. The median smashed through $1 million, guys. Interstate migration is still massive. Adelaide, solid, serious momentum, up around 1.9%. That's incredible. Demand is deep, stock is shallow. Buyers are fighting for anything affordable. Darwin, the quiet outperformer, strongest annual growth after Perth, a very real turnaround in market conditions. Melbourne, not slowing, not shrinking, steady rebuilding and gearing up for something big, the next big growth market. Why? It is now one of the most affordable major cities. There is continuing to be a massive migration return. Students, workers, families, investors are re-entering because yields are rising, and every major bank has upgraded Melbourne's 2026 outlook. Historically, Melbourne always rebounds after lagging early. This has been the story over the last 2 decades. Melbourne isn't loud like Perth or Brisbane, but it's tightening. absorbing demand and setting up for 2026 to be its comeback year. And then you've got Sydney. You'd think Sydney is cooked, right? Houses at 2 million, 3 million, units at 1.2 million, record unaffordability, borrowing limits have been stretched to breaking point. But here's the twist that nobody talks about. Sydney is actually two completely different markets. Segment B, inner Sydney, where density is high, supply is fixed, and nothing affordable ever comes up. Segment A, Western Sydney. Yes, Western Sydney is absolutely part of the boom. Here's why. It's where new migrants are moving. It's where young families can still buy. It's where new supply can actually come online. It's where developers and investors are active. And it's the exact price band soaked up by the 5% deposit scheme. Western Sydney is still rising fast while inner suburbs are losing steam. Now let's flip it and talk about segment B, the parts of the market that are finally starting to slow down. And I want to be really clear here, we're not talking about whole cities crashing. We are talking about specific price tiers and specific suburbs where people have simply hit the limit of what they can borrow. And let's start with inner Sydney. These are inner Sydney high-end pockets. Think about suburbs where apartments start at 1.2 million, houses are 2 million, 3 million, 4 million and up. Buyers are already at full borrowing capacity. In those pockets, you're seeing lower auction clearance rates, longer days on market, fewer people turning up at open homes, and buyers walking away because numbers just don't work anymore. That's segment B. Not because the market is weak, but because borrowing power is maxed out. At the very top end, in the most expensive pockets, the numbers have stopped stacking up for average buyers. Everywhere else, demand is still there. And you might be thinking, Scott, if rates aren't coming down again, if APRA is tightening lending, if affordability is the worst it's ever been, shouldn't this all be calling the market? The short answer, not yet. And I know I sound like a broken record, but I need to say this again, and then we'll move on. We've had 3 rate cuts already. That fire is already lit. We've got 5% deposit schemes expanded and uncapped. We've got higher levels of migration. We've got stock levels that are still very tight. And new housing completions are nowhere near what the government promised. Put simply, demand has had rocket fuel poured on it and supply is still stuck in first gear. On top of that, you've got the bank of mum and dad stepping in with equity and gifts and loans. You have record numbers of investors looking at rents and saying, I want in before the next leg up. Buyers are shifting from houses to units and townhouses in the expensive capitals because that's the only way to get something half decent. The boom might change shape. You'll see more buyers pivoting into units in expensive areas, more buyers push into outer and middle rings, more pressure on the affordable corridors. But is the boom over? Not with these settings, guys. If we keep running like this, you're very realistically looking at 10% plus national growth over the next 12 months. This is not normal. That is a serious boom. So where should buyers actually be looking if they want to ride this next 12 to 24 month growth period? Let me keep this really simple and really practical. These are the types of corridors we're focusing on right now. Sydney, we're looking at northwest and western growth corridors, the parts of Sydney where new supply can still come online and you're not competing with $3 million terraces near the beach. Melbourne, the northern, western and southeast corridors, including the inner middle ring townhouses and unit pockets that still offer real value compared to Sydney. Brisbane and surrounds, there are areas 20 to 50 minutes out from the Brisbane CBD that you need to have your eye on. Adelaide, mainly the northern regions where demand is deep, prices are still workable, and there's room for growth. Perth, the inner middle ring and the major northern coastal, northern inland, southeast, and southern coastal corridors, the place is still early in the cycle, but already showing strong price pressure. I'm not going to rattle off suburb names here. That's what our research team is for. But at a high level, this is what you want to look at. You want to look at what corridor, what region do I need to be in? So there you have it. Prices still rising. The market split into 2 segments and the so-called headwinds barely making a dent so far. Tell me in the comments, which city do you think is going to run hardest in 2026? Perth, Brisbane, Adelaide, Melbourne, or somewhere else? And if you don't want to sit on the sidelines and just watch this boom happen to you, this is your daily property update, your 5 to 7 minute update on the property market every single day, so that you can become a property insider. Make sure to hit subscribe so you never miss a video.